Welcome to The Foundry, where leaders are forged daily. And now your host, George Roberts.
Welcome back, entrepreneurs. Today, we welcome Mike Hardy, founder of the Cyrus Opportunity Zone Fund. Mike is a highly sought-after speaker who has been quoted on Fox Business News and has been interviewed on USA Today. You'll definitely want to listen to the entire episode today because we will discuss opportunity zones, which have been called the world's best tax strategy that you've never heard of. We will also discuss creating systems, leadership, time management tips, as well as the 2007 housing crash and what you can learn from it to protect yourself today. Welcome to the show, Mike.
Thank you. Great to be here, George. Appreciate it.
All right. Well, I'm really excited about this interview because, Mike, you've been described as a Renaissance man. You're an Iron Man, a pilot, and a philanthropist. Tell our audience briefly, who is Mike Hardy?
Great question. Well, I should say I'm a husband and a father first. I'm married 25 years. I've got 4 kids. My oldest is 21. My youngest is 14, boy, girl, boy, boy, and just got to have them all together for Thanksgiving. So that was kind of nice. And my kids are actually silent investors with me on certain projects. So that's kind of fun. Maybe we'll get into that in a little bit. But I'm just somebody that I feel that we have one life to live, and there's no reason to do anything short of maximize every aspect of that. That includes both personally and professionally. So I'm very driven as an individual. I'll get something in my sights and go after it. And that's how a lot of this has come about. So look forward to our conversation.
All right. I love all that energy. Well, let's just get right into it. Let's talk about opportunity zones. And first, I understand that you got into this space because you saw that as an investor, there was really not a lot of people out there that were describing this. And it is complex, by the way, this very complex system or tax strategy in a good way, and just kind of stepped into the breach. Is that accurate?
You know, it is. I'll give you the short version of how this developed, but I'm a former financial advisor prior to being in the real estate and mortgage banking space. And at the time, this is a number of years ago, I was the chair of Azusa Pacific University's Financial Advisor Network. And we were doing public facing education. And so we would do things that we would invite financial advisors, CPA, real estate professionals. And we decided we're going to host a public event that would be on creative tax advantage strategies in real estate. So we had a 1031 expert. We had somebody talking about DSTs. We had someone talking about the 721 provision. We had an individual that was an expert with charitable remainder trusts. And there's this new idea called the opportunity zone that was just coming to the surface, and we couldn't find an expert to talk about it. So I said, you know what? I will do it as an investor. We'll have a caveat. I'll take a smaller section. I'll just walk through the wave tops on it. So I had to spend the better part of 3 weeks preparing for this talk. And lo and behold, I kept asking myself, how is this? This just seems too good to be true. So that's how it started, is I had to give a talk on the OZ before I knew anything about it, as how it could potentially be an advantage for an investor. And that was my introduction.
Okay, amazing story. And I just love it. So it has been called the world's best tax strategy that you have never heard of. Tell me why. Why are there not more people taking advantage of opportunity zones?
You know, I think a part of it that's actually plagued me for a little bit. I've settled on a couple of different reasons why. First is, most of the time, this is something where the majority of CPAs look in the rearview mirror, not forward looking. And the 1031 exchange is a very common strategy, and it's something that everyone knows about. But because this is something that came from the 2017 Tax Act, and it wasn't really even, there was some murkiness until I believe it was 2018, 2019, it's just very new. It's very new. And so because of that, one of the challenges is that in order to participate in the opportunity zone, the majority of folks that do this are going to need to be accredited investors. So you have a combination of, it's very new. Majority of CPAs are backward looking, not forward looking. There's an element of uncertainty to it. And there's a combination of new tax law and investment strategy. So it's just a different animal. And now, as I've been in this for a while, I realized that a lot of the, family offices and uber wealthy, they do this as a matter of practice. It just doesn't make its way down to Main Street very often.
Right. And again, I'm certainly no expert, but I'm fascinated by the strategy. And I feel that to get your full benefit out of this, you have to stay in the deal for 10 years. Is that correct?
It is. So there's the most significant advantage comes by having your money invested in a qualified opportunity fund for a 10-year window. And as long as it's in there for a 10-year window, you have the benefit of tax-free compounding growth, and very similar to a Roth IRA strategy, a tax-free exit of your invested funds. All the growth from the funds come out tax-free. So it unheard of in the investment world, and sort of the Roth IRA and other areas where you've got some sort of a cap and, you know, a little bit of a different strategy, obviously, than a 1031 exchange, but something that I think everyone should know about.
Yeah. And I like to call it a 1031 for everything, because it doesn't matter. I mean, I could have real estate gains. I could have gains in the stock market, whatever it is, cryptocurrency. I can take these gains, and if I invest in a qualified opportunity zone fund, you follow all the rules, 10 years down the road, boom, all of that money, it's literally amazing, just tax-free.
It's the world's best kept tax secret, I'm telling you. And I think, you know, one of the interesting things about it, there's a shelf life to it. And I'm not a tax expert. I'm coming at this as an investor first, and then as somebody that, in addition to seeing, you know, my own pain with capital gains tax, realizing that there's a lot of folks that don't know it exists. And so, you know, this really birthed from a place of just childlike awe of what was possible to be way more efficient from a tax perspective.
Well, I love it. And I say the politicians, they put things in the tax code for a reason. I mean, people, mainly journalists, they talk about loopholes and they get upset about things. But really, I mean, these things were put there not like Easter eggs. They were meant to be found, right? We're supposed to go in there, and these are the things that the government says we need to be doing more of.
You know, it's brilliant from a helping everybody win. You know, the essence of the opportunity zone is, you know, roughly 20% of the United States is designated as an opportunity zone. And that happens to be technically the poorer sections, the lower income areas. And so what this does is it attracts investment capital to those areas in a way and a pace that never has happened before in recorded history, and wouldn't except for the tax incentives that are provided. And so everybody wins with something like this. It's not just the investors, it's not just the, you know, the ultra net worth individuals, but I think that it's something where everyone can win, because you can even have the mom and pop investors that, you know, that have the opportunity to participate in 10 years of compounding growth, tax-free exit. And as long as those investments meet the OZ criteria, and they're in that opportunity, 70% of it needs to be inside of the opportunity zone. It's a win for everybody. So that's how I see it.
Yeah. And I think it kind of fits in with some other things that are going on, like low income housing. This particularly, the opportunity zone, as I understand, is something more commonly used to revitalize the buildings that already exist. I mean, if you go back like maybe 100 years or more, we had boarding houses, and, you know, that's how poor people might live. Or maybe earlier in your life, you're getting a start. And now, you know, there's this realization that if we don't have the government do something, you know, put some money in either directly or indirectly, I'd say this is indirectly because it's through getting rid of the tax burden, then I mean, there's just no way to build affordable housing and to revitalize the housing that exists in some of these areas.
Yeah, it's pretty creative. I mean, it's something where both sides of the aisle feel very good about it, because, you know, we're at the end of the day, we're bringing money to areas that need money and wouldn't otherwise have it. And then investors that are always looking for, you know, what's my best opportunity to maximize building wealth. It works. So I think it's pretty neat.
Yeah, and it's all through tax cuts, right? So it's hard to find people who are against tax cuts.
That's right.
Okay, now I think you mentioned the main justification behind the program, which of course is you have these poorer areas and we don't want to just let them rot. You know, we want to bring up the whole country. And how do we do that? How do you bring investment dollars into areas that otherwise might not be getting them? But isn't there another side to it as well? My understanding is that I think 10% of these opportunity zones are defined by politicians rather than need. Is that right?
You know, I don't know that I have the answer to that, but there is What I do understand is that each state has the ability to designate where their opportunity zones are going to be. And the spirit of the rule of the law was that it needs to be the lower income in areas that need development. I'm sure there's some carve outs that took place in there as this was getting passed. I don't know the details there, but from what I understand and what I've seen, at least in the areas in California that we do business and some other areas I've looked, it seems like it's been pretty spot on from what I've seen.
Good. Well, I'm glad to hear the program is used properly, but I've heard of people going into opportunity zones saying, hey, why don't I invest tax-free, take all the benefits of the program, and in many cases, not have to invest in truly the poorest areas. But again, 20% of the country, I mean, you got to know there are a lot of areas that are not necessarily crime centers that are designated as opportunity zones.
Right. Yeah. And I think, like all things in life, it's what we all want to do is understand what are the guardrails and how does everybody win? And so, it's up to our elected officials to do right from a framework standpoint, and then, investors and others to follow the rules and the law to the benefit of all involved.
Awesome. Well, I think you did a pretty good job of going through the advantage of investing in opportunity zones for investors and your real estate professionals. I don't know if there's anything you want to add to that, but if not, then we can kind of go on to what are the rules? I mean, they're kind of arcane. I mean, I think you got to be in there 10 years, like you said, and I think you have to have CapEx equal to your purchase budget. Is that right?
Right. After you back out the land value, you need to have development that's going to be equal to the existing structural value. So there's some rules to follow to be able to make sure that we're honoring the tax code. And there's a lot of latitude, quite frankly. And we've been fortunate to just realize that I think too, one of the things I've noticed over the years, and this actually stemmed from some of my pain before. I've had a blown 1031 exchange, and next thing I know, I'm paying a chunk of tax. So the most significant advantage that I've noticed here is that, and this doesn't have to be just real estate capital gains. This is any capital gain. So if there's an investor that has a blown 1031 exchange, which quite frankly, a lot of the investors in our fund is they didn't have an ideal down leg option, or it fell apart partway through. What the benefit for the investor is that they're able to take their principal back and only invest the gains. You can separate the gains from your principal and then reinvest your principal wherever you think is best fit. So the tax advantages only apply to capital gains, not to just typical cash investors, even though we do have some cash investors. But that's a clear distinction, and something very different from a 1031 is you don't have to move everything into this strategy. It can be sale of stocks, it can be sale of art, it can be real estate. I've had a lot of folks that didn't realize this was an option, sold real estate, had a tax bill due, was referred from a CPA. There are some that are very forward looking and realize, oh my goodness, I can significantly mitigate my tax simply by participating in an opportunity zone fund.
Great. And one of the reasons why I like to talk about the rules is that I always want to figure out, can I do this myself? Should I do this myself? But as usual, you go to a new form of real estate or a new strategy, and then you realize, okay, maybe I can do this myself, but maybe I shouldn't. So let's say that I am in that position, like I've got a blown 1031 exchange or selling anything, including a piece of art, and have a huge capital gain. And if I invest, for example, in your fund, I mean, do you actually have to deploy those funds within a certain amount of time? I mean, if I'm getting to the end of whatever, I mean, I'm not schooled on all the time frames. I mean, when is my money safe? Is it when I invest in the fund, or does it have to go through some further stages?
Great question. So unlike a 1031 exchange, your funds don't need to go to an accommodator. You can take possession of your funds. Let's say you have a real estate project that you sell. You physically take possession of the funds. As long as you've moved them from your possession within 180 days into a qualified opportunity fund, the tax treatment still applies.
Yeah.
So we're set up to be able to have openings in July and in January, the month of July, in order to accommodate those 180-day windows for folks that have taken constructive receipt between windows. So that's our setup. But yeah, it's pretty unique that way. It's sort of the 180 days, again, a relevant number, but as opposed to the 1031 and sitting with an accommodator to then land in another property, you can have that in your bank account. And as long as before day 181, it's moved from your account into an opportunity fund, you're in good shape.
Yeah, and I'm glad you mentioned that about 1031 exchanges, because I have heard from these intermediaries or accommodators that the number one mistake people make is they take possession of the funds. And at that point, well, your 1031 accommodators are going to say, well, sorry, it's too late. But then enter Mike Hardy. You can talk to somebody like you and then put those funds into your qualified fund, and it's not over yet.
That's right. Yeah, and I'm going to say about 20% of our investors didn't know this was an option and found out before the 180-day window expired that they did have the opportunity to significantly mitigate a tax bill. So yeah, again, it's a new animal. And, we're going to have, I hear the legislation may be changing, it may be extending a bit, but at least as far as I understand right now, this opportunity will sunset in 2026. Mm-hmm. And so then anybody that has received capital gains, they can move into a qualified opportunity fund before 2026. That may get extended a couple of years. Actually, I haven't looked into the details on it, but
right.
And then of course the 10-year holding period. Now, keep in mind, we're set up for maximum flexibility. I set this up really just to think like an investor. What would an investor want? So if somebody needs liquidity for any reason, they can pull their funds out every January, just like a 1-year CD. So there's only a 1-year lockup. Now they lose the tax treatment, but the point is we wanted somebody to have the benefit of the 10-year window. But if for whatever reason they need their funds or a portion of their funds, wait till January, give us a 90-day notice, and we're happy to provide the liquidity.
Yeah, I think that's amazing. Well, with that, let me see what we should move on to. I think that a lot of people would really like to hear about the 2007 crash. I think there are ever more comparisons between the past and the present. We have some pretty apocalyptic predictions going around these days. What would you say you expect based on current economics? And to give you a sort of a caveat, we're recording this at the very end of November 2022.
No, it's a great question. I think human nature is to take a recent experience and project it forward. And so what we need to do, we actually do a presentation on this, and that's where we've been getting quoted in Fox News and Fortune and a couple of the other USA Today, specifically on looking at the similarities and the differences between 2008 and 2022. Will 2023 look like 2008 is really the question we're wanting to answer. And so what we do is we go through and we do basically similarities and differences of all the various supply and demand areas that exist. And so we actually find that it's very different when we look at the data. And I have hundreds of hours researching this, and I'm researching this obviously for a whole number of purposes, but or a number of reasons. But when we look at the data, this market seems very similar to early 80s rather than the 08 era. Okay. And one of the key differences, sort of a little known issue, is there is a massive demographic difference. There is an inordinately higher amount of demand that exists today for housing than there was back in 07 and 08. I mean, it's overwhelming. And the difference, quite frankly, is the difference in size between the X generation and the difference between the millennials. And so I've got demographic charts that show rolling birth rates year by year and looking at when people typically buy. Overwhelming number of folks buy in their early 30s. And if you look at the number of 30-year-olds to 35-year-olds that are pouring into the market today and will continue pouring into the market, and you compare that's one of about 6 or 7 things that's a key difference. There's some similarities, but that's a big difference. It's actually giving us a lot more support than people realize, because quite frankly, there's just way more people that need homes than homes available.
Yeah, I think great comparison. Obviously, that's when we saw rates still sky high through the early 80s. And what about 1990? Any parallels at all that you see there?
I don't know if I know enough about the 90s. I'm looking specifically, I mean, that a lot of that had to do with the Reagan Tax Act, from what I understand, and all of a sudden having a depreciation play that evaporated in short order. And I think there's a lot of damage done more from the tax changes that took place rather than fundamentals. So, I think I've got a saying, which is math tells a story. Let's just look at the math. Let's look at the data. Let's look at the facts, not the feelings. And so when we want to answer the question, where is housing going to go in the future? Because this is what I'm wanting to answer. We serve about 1,000, 1,200 families a year on the mortgage side as well. I'm a partner in a Churchill mortgage banking firm. And, so a lot of our clients are looking to us to ask, really quite simply, is it safe to buy? If I buy a home, is the bottom going to fall out? And am I going to lose 30% of my equity like many folks did back in 08 and 09? And so when we want to answer the question, where's housing going? There's really four key things. Like, what does the supply look like? What does the demand look like? What is the affordability issue, right? Because that can change very fast. And that's a big problem today. That's a big problem. And then what is the availability of credit and stability of credit? Okay, so supply, demand, affordability, and then credit availability. And when we really dive into those four things, it gives us a good picture of what the future will look like compared to the past, looking at the similarities and differences of all those.
Well, you want to just hit those one at a time. So there's the supply and demand thing. Obviously, the builders aren't building, and we have historically low houses on the market when you compare this to prior crises.
Yeah, absolutely. So when we go back to 08, we had a significant oversupply of homes comparing to the demand. And I didn't even realize we're going to go here in this. One of the things, maybe we can do a part 2, or I'll invite you to an event, but I've got some slides specifically on this, but let's see if I can just talk through this for the listeners.
I'll allow you to share screen if you want, because I'd love it. I mean, we do have YouTube, so I think that would be really exciting if you want to show us some slides.
I may be able to do that.
All right, I think we can just riff over it while you're looking.
Let me talk through it while I'm looking for the presentation. Okay, so if we look at, we just covered the demand. The demand right now, we have the number of new buyers pouring into the marketplace compared to the buyers back in 06. If you look at year over year, 06, 07, 08, 9, 10, 11. The early 30-year-olds had a dramatic fall off. Almost no one talks about this or looks at this data, but there was a significant, a sharp adjustment in new buyers coming to the marketplace that happened right at the same time as builders had record supply going onto the marketplace. And you had about a third of all products were adjustable rate mortgages with folks that couldn't qualify for them. So you had four things that kind of created this perfect storm all at once. Okay. And that was right at the end of 2007, 100 and 110 the next year, and 120 the next year, and 130 the next. And we're going to have that for a couple of more years. Okay. So the other thing we have now, it's very different, is, and we've been, over the last 5 years, again, we've helped about 5,000 families with purchase or refinance. So we look at the credit profile of all of the individual buyers coming to the marketplace, and it is super solid from a credit profile. Okay, very different. There's about, I'm going to say 1/3 of mortgages have adjustable mortgage rate risk. There's a few more than that. There's more than that from a percentage standpoint, but actually have risk because maybe they're 5-year fixed or 7-year, 10-year fixed, even though they're technically adjustable. So anyway, my point is, like, the credit profile is super solid, where it was very, sketchy, for lack of a better term, back prior. The issue that's the same that we're dealing with is affordability. Right now, we have a significant affordability challenge that exists. We're right up and very similar. I think we might have even just surpassed the affordability price point, where I think it's we're actually even slightly worse, if I'm remembering some recent data, of where we were in 07 or 08. So what that means is that's slowing down, it's tempering buyers coming to the market. But guess what? They have to go somewhere. So they're going to rent, or they're going to have a lack of what's called household formations. They're going to stay living in the basement or with mom and dad or wherever it is. So that's pent up demand that's coming. It's just not here yet because of the affordability issue.
Yeah, outstanding. So we covered at least supply We've covered the demand issue. And let me see, I know you listed 4. What were your other 2 factors that you were mentioning?
Supply, demand, credit availability,
Yes.
and buyer affordability.
Credit availability. Yeah. So obviously those 2 are working at cross purposes right now. Hard to get the financing, at least at a decent price. I mean, obviously this is what's driving prices down at the present moment. And definitely a wild card. I mean, I don't think we've ever been so underbuilt in this country. And yet at the same time, with rates rising so quickly, who knows?
Right. No, I absolutely agree.
So in the 1980s, one thing we didn't see was prices coming down. We did see rates shoot up, but they were from much more, I would say, normal mortgage rates. We're not shooting up from 2.65 like we are this time. So it's difficult to find those historical analogs.
Yeah, the other thing too, I was just thinking through what are the things that could cause a crash, and really it has to do with liquidity versus illiquidity. And we're about one of the most liquid markets we've had in 100 years compared to the most illiquid market we had back during the Great Recession. So huge difference from a liquidity standpoint. Go back in 2008 and there was about 25% of all properties were underwater. And if you look at the data today, there's about 1 to 2% of properties are underwater. So from an equity standpoint, and you look at, okay, you look at what percentage of properties are free and clear. Like if I kind of put it in a couple buckets in my mind to assess the risk, you've got a little less than 30% of all properties are free and clear. Okay. We've got about another 1/3 to 40% of all individuals don't have an affordability issue. They're not happy about where interest rates are, but they don't have an affordability issue. It's a first-time buyer, which is about 1/3 of all buyers, that all of a sudden they were buyers and now they can't, or they got to wait till they get a raise, or they have to wait till rates get back into the 5s from 6s or 7s, and then they'll start venturing back into the market. So those are the moving targets. I mean, I do see have seen a fair amount of softening, but I just don't see the bottom falling out when I look at the fundamentals. I was going to say I'm in here, and I consider myself like I'm an investor that sort of plays in the space just above mom and pop, but below a lot of like the Wall Street funds. Okay. I'm here, listening to the, some guys that run billions of dollars and thinking, am I missing something? Like what am I missing anything with my hundreds of hours of research in here? And, what I keep coming to over and over again is that I'm not. Yeah, there's pockets that are going to be softening. There's pockets where there's some adjustment, but the bottom won't fall out. And a lot of the guys that have significant dollars on the line, they're marching forward, knowing that. In fact, I just read this. Chase has JP Morgan has roughly $1 billion that they're putting into build to rent properties. This is a fairly recent article that I read. So my point is, like, institutional money is not shying away from residential real estate. Like, that should tell us something.
Exactly. The so-called smart money, as opposed to the retail investors. Now, from here, I mean, I'm just so excited about the 2007, the crash and all that. It's hard to leave, but you mentioned maybe wanting to come back, so I think we should do that.
Okay.
Podcast released just before this. We're going to do exactly that. It seems like everybody is discussing the former crash. Are we going to crash? What's different this time? And here's one last thing that's different. Bank solvency. Banks are just much stronger this time around. So the idea that they're going to be a part of maybe not lending, not providing liquidity, that doesn't seem likely this time.
Right. Yeah, I would agree with you on that. And I mean, a lot of this stuff gets absorbed and packaged and put into the, we end up buying this in our mutual funds and pension plans. But if you look at all of the debt that's been packaged in the last decade, it is very clean business. And looking at the credit profiles, I mean, the credit scores are in the mid to high 700s for the majority of folks that are here. So we've got a significant reduction in risk. And then liquidity, and banks, like, to your point, they're sitting on more cash than they've ever sat on in the past. Right. So there's not a liquidity issue by any means.
And then the sad side of that is, although homeowners do have a much stronger credit profile, we have a lot more tenants today. because a lot of those people that might have been marginal in the past and they were sort of pushed in there, and I'm just going to say it, maybe by government programs or just maybe by abnormally low interest rates, all of those things that had been pushing people into home ownership, those people are now on the outside and not likely to contribute to credit issues. It's definitely a different game this time around.
Yeah, you're absolutely right. It is. I mean, that was one of the key lessons that was learned last cycle. And what we have now is we've got just a very clean book of business across the board.
Right.
I don't see that changing anytime soon. Like I see many more people that I think can and should be able to buy and have to take, some sort of a hybrid loan that might be slightly higher interest rate or more down payment because they're self-employed. And I'm looking at their profile. I'm thinking I would loan my money to this individual all day and twice on Sunday. Yet it's complicated to get financing again because of Frank Dodd and what went down back 15 years ago.
I was wondering if you're going to mention that. I was about to say that it's difficult to get a loan if you're buying a smaller house. It's just not a qualifying mortgage. And without that safe harbor, a lot of the mortgage companies, they just don't want to touch it. So anyway, I think it's good that we're talking about the good and the bad and everything. Each one of these programs, whatever it solves, is also going to harm somebody. And I'm not here to tell people what to believe, but I think we definitely do need to think 2 steps down the road and weigh it all out and make sure it all makes sense. So without a doubt, having a stronger banking system is a good thing. People not being able to get into a home is kind of sad, but at the end of the day, again, we have to decide where to draw the line. And I guess that's where government comes in.
Right. I'm always going to be in favor of the entrepreneur and betting on people and betting on innovation. But at the same time, I want people to have skin in the game. I think I've learned that the hard way over the years is you can't want something for somebody more than if they want it for themselves. And so there's some basic, it comes down to the basic things. And I assess it really simply that way. It's like, all right, is this person responsible? How is their income related to their expenses? I mean, you can look at, I can meet anybody and talk to them for about 5-10 minutes and ask them a series of questions and usually have a pretty good predictor of what their future is going to look like based on the actions of the past over the, last couple of years. So I think that, if there's any one thing that we all have to do is we all have to take individual responsibility first. And that's not a cure-all. Sometimes you still run into issues down the line. But when I see people take individual responsibility first and work hard and go above and beyond, guess what? Over time, the significant majority of them end up doing very, very well, just simply by following those basics.
Yeah. Well, I love these emerging themes, individual responsibility, and what true capitalism is, right? It's not having no rules. It's about having rules that, for example, back up property rights or forcing people to have skin in the game. Those sorts of things are good. And I would say benefit capitalism. I think that you'd probably agree.
Oh, yeah, 100%. I think America's by no means perfect, but what we do is we give opportunity for people to create something that didn't have anything in the past. And I think that there's opportunity everywhere. I just read, this is one of the sayings that came out of the seminar I'm here today. And I think it's Winston Churchill, but it was along the lines of an optimist sees possibility and opportunity in every difficulty, and a pessimist sees difficulty in every opportunity. And so a lot of it just has to do with our perspective. Again, individual responsibility first, but looking to see what's possible and then creating a vision and a plan to go that direction. I think that's what everybody has to do on their own, and no one can do for them.
I love it. Preach. So love to talk about your 3 greatest strengths. Just really briefly, let's hit on these. Networking. What are some of your networking tips?
Great question. So something that I like to do is if I go to an event, first of all, I'll try to go to an event once a month that I just think is going to be maybe on the outskirts of what would be my typical focus, more to expand the thinking. So I'm a believer in iron sharpens iron, and I'm a believer that one new idea or one new relationship can completely change the trajectory of your life. So something I will do is I will look to see, who is it at this event? If I could only continue a relationship with one person, who would it be and why? Because so often I think people do the opposite. There's 100 people, give me 100 cards, and that just, just white out noise. And so for me, I'm thinking, if I could only continue a relationship with one person. Who do I want to meet? Why do I want to meet them? And then sometimes the other thing I like to think through is, and I think life is kind of fun this way, is I don't always know when I meet somebody if I'm supposed to help them, if they're supposed to help me, or if we're supposed to help each other. But I want to be open to all of them, right? Because sometimes there can be somebody, and maybe there's no benefit for me in this whatsoever, but we're going to cross paths, and I'm going to give them a connection or a relationship or a view or advice or whatever it is that will set them on a new trajectory. And I think that's pretty amazing about life. And sometimes that happens to me, but if I can be on the lookout for both, I think it makes life more fulfilling.
I love it. So I was going to summarize that. I would say for number one, networking, it's about quality, not quantity.
It is, couldn't say it better. It is about quality, not quantity. And, I'm also a believer that we end up taking on the characteristics of the people that we associate with over time. It's like we can curate our environment, and then as we go through life, we become like the environment. You can't help but take on the characteristics of the environment that you exist in. So the question is how to be curating that, and then always improving it and refining it and placing the right people and the right opportunities in your environment to help you grow.
Outstanding. Now, what about leadership? And we've just touched on mortgage lending. So we're going to talk about mortgage lending in a minute, but before we go into the specifics, could you just give us maybe a quick anecdote? Tell us, what is the greatest leadership lesson you've learned?
Ooh, greatest leadership lesson I've learned. It is lead yourself first. Mm-hmm. I think three of the most powerful words in the English language are I am responsible. 100% I'm responsible. And if I don't lead myself first, I don't believe that I have a right to have others follow me or to lead others. That's stacks of hypocrisy. And you see that everywhere, is folks that are in charge, but they're not accountable. They're not doing what it is that they're requiring others to do. So my lesson is that if I am taking 100% responsibility for myself and investing in myself, and always like thinking through how can I not just allow myself to win, but everybody that's on the team, how can I create an environment that allows people to think bigger and see things that maybe they couldn't see on their own. I feel like then I'm truly doing some good and some value in terms of bringing leadership to others.
Yeah, outstanding. I'll just share with you before we move on to number three. My favorite quote about responsibility is that it's expansive, right? You can take responsibility for yourself. You can always take more responsibility. And it's not really an indictment of how you behaved in a situation. But again, you could always go back and say, what else could I have done?
Yeah, 100%. There's I just heard this recently, but I thought it was helpful. It's like anytime you go through and you do something new, maybe it's a presentation, maybe it's, whatever it is, you go through and answer the question, what did I do right? Or what did I do well? And then the next question is not like, what did I suck at? But if I could do something different next time, what would it be? Right. So always looking through the positive lens on both. So, yeah, I agree. I'm a big fan of responsibility and leadership. And I think that when those two go hand in hand, opportunity after opportunity after opportunity opens up, because I think this world is just craving people that are stable, that are genuine, that are trustworthy, that have a level of competency, and that live life with intention. So those are the things that I embrace.
I love it. And I feel like number one and two, networking and leadership, namely, lead us to number three, which is relationship building. So tell us about relationship building. What are your tips? What's your message on relationship building?
Well, that's a good question. So what immediately comes to mind is that I have this theory or belief that like every person that exists on this planet has a streak of genius in them. And part of our journey on this planet is to figure out what our genius is and productively apply it in all areas of life in a way that doesn't just help us, but helps others. And so when it comes to relationships, I think this is like something I heard from Les Brown years ago, which I thought was really kind of sobering, but it was most people are born unique, but then most people die as clones. It's like over time, people end up just sort of gravitating to the mean and not living like in their, with their streak of genius, I guess. And so when it comes to relationships, like that's what I look for, is what's something unique about somebody. Where do they excel? Where do they have something where they can offer the world that is just above and beyond others, that can carve a path for them? And so I'm just intrigued by that on the human nature side. And then when it comes to relationship, this is something that for my group that will hire and fire to, quite frankly. And I call them the 5 C's, and it's people of character first. Character is always going to be first, and then their level of competency, and then are they an individual of compassion, and then are they coachable, and then do they operate with courage? So character, competent, compassion, coachable, and courage. And so from a relationship standpoint, when I find people that have those five C's, guess what? All of a sudden, life just gets a lot easier and better because they're the right people. And then in terms of doing business with folks, my litmus test is super simple. It's those first 3, right? Because I'm not there to coach them, but it's, do they have character? Do they have a competency in the area that we're going to be doing business in? And then do they have enough compassion so that they're looking out for a win-win for everybody, not just purely 100% self-interest? So that's something that has really helped me simplify and quickly weed out the wrong people and stay close to the right people.
Wow, I'm loving it. But we have to move on to time management. So maybe a little irony there.
Yeah.
So I understand that in addition to all we've discussed so far, you are overseeing 30 employees as the managing partner for California business for Churchill Mortgage. So obviously, you didn't have to tell me on your one pager that I, Mike Hardy, am good at time management. Obviously, you've got some tips for us. So tell us what those might be.
Yeah, absolutely. So I'm kind of a less is more guy. I'm a recovering do-it-yourselfer. And so in every area of life now, I look for somebody that is maybe better than me in a certain area, have complementary strengths or complementary genius. And so I've realized over the years that my strength is in like kind of invention and innovation and vision, and seeing maybe what others can't necessarily see. But the further I get into the detail, the less I like it and the less of a natural skill set it is. So I read a book recently, I'm reading it a second time now, but it's pretty fascinating. It's called Who, Not How. Who, Not How. And it's by Dan Sullivan and Benjamin Hardy, no relation. But I like to meet the guy. And they talk about how everything that needs to be done, we're all trained to figure out the how, and it's the how that takes so much time. And so it's a different level of thinking. So anytime I have an issue now or a problem that I run into, instead of me trying to think of how can I solve this, and there's always a time commitment with the how, it's who can solve this. And so that's been my MO now for quite a while, is aligning with the right who's, and then making sure that they fit those 5 C's that I was talking about earlier.
Yeah, I love all the theme of recovery. I mean, I myself, I'm a recovering do-it-yourselfer, a recovering PhD, a lot of recovery going on here. So I would just love for this interview to go on and on, but I think we started at the top of the hour and we're almost at the bottom of the hour here. So I think we're going to have to, sorry, before we head up to the lightning round, you mentioned that your kids are shadow investors in your deal. So tell me exactly, how does that work? What's the object here?
Sure. So each time I have like a new, flip project or something comes up, I'll let my kids know kind of what we've got going on, and, walk them through an Excel sheet so they can start to think like investors. I just think there's very different disciplines between making money, between saving or keeping money, and then growing money. And so I want them to understand that at an early age. So something I've done recently is like I had my 16-year-old, I actually incentivized him to read The Richest Man in Babylon, and then gave him cash rewards for reading it, and then another $100 if he did a book report on it. And so I want them to start to think at an early age, just have a perspective that is incentivizing them. They go to private school. So I'm thinking like, why would I not just pay him to do the things that I think are going to provide some of the best education? So now with that, he's thinking through a lot of the bigger picture lessons of investing, and I'll just walk him through a upcoming flip project, for example, and look at the, rate of return and the annualized rate of return, and ask him how much he'd like to invest. And so then he'll just, I remember the first one that we did, he decided he was going to cash in, like he had an Amazon card and some Starbucks card. He's like, Dad, can I put these into the deal? Right. So scraped together $1,000, and I think we made that was a pretty good one. That was like about it was in the 20s, 20%, 25%. On this one project, but I just want him thinking bigger. And so anytime something comes up, I'll share with him, and hey, maybe he wants a new iPhone. Maybe he's going to want to invest. I can't control it, but I can at least give him the opportunity.
Okay, great. So they're actually putting skin in the game. So when you say shadow investing, I'm thinking that this is on paper, but this is real life here. We're live.
This is money. Yep. He's got to get the money, and he puts it in an envelope and he gives it to me, and I'm the bank. And so yeah, so I'm keeping it till the deal's done, and then we walk through the numbers and I give him his payout. It's kind of fun.
I love it. That's beautiful and amazing. And with my children, we've been studying Benjamin Graham and having my youngest son pick stocks. So he studied that really hard with me for a while. We went through all the principles, all the basics of value investing, because I feel that all true investing is value investing on some level. And I like stocks because I do think that when you're with equities, it's really easy to get in and out. And it's exciting for kids because, I mean, business is everything in life. And so whatever you're interested in, there's the business that does that. Just go and figure out, let's look at their financial statements, let's understand their market, and let's see whether it makes sense to make an intelligent investment in this company.
100%. My dad helped me with that as a kid, and he did some similar things. And so I remember being able to earn money by not just working, but by learning. And he would give me shares of stock. He worked for Amgen at the time, and said, I'll give you a share of stock after you read this book and we talk about it. So that's kind of how it started for me. And so now it's my turn to pass it on to my kids.
I love it. These are great methods. If half the parents listening would do at least one of these methods, I swear we're going to have a much more financially savvy generation. All right, so now it's time to step into the lightning round. Are you ready, Mike?
Sure, let's do it.
All right, tell me something about one of your real estate markets that most people wouldn't know.
There's, even over the last year in Southern California, there's a tremendous amount of off-market opportunities that exist and still exist today. And I think it's for me, being at a place where I've become known as an investor and somebody that can close quickly. And I just find that there's massive inefficiencies that exist in real estate that if you just take the time to look, they exist. And you wouldn't think that about Southern California, but it's very true. I've experienced it personally.
Amazing. What is some advice you would give your younger self?
I would have to say, take more risk, go for it big. Life is short, and I'm a recovering, taking very minimal calculated risk over the years. And if I was to do it again, I would go for it 10 times over from what I did as a youngster, because I think I was too concerned about what other people would think, like during high school and maybe early college years. And it's so irrelevant now looking back.
Amazing. What is the best real estate advice you've ever received?
The money's made when you buy, not when you sell. So I'm a value investor as well. And I'm never banking on any appreciation. I may even sometimes will bank on, maybe some minor course corrections. So that's hope is not a plan. That'd be my advice.
And we know that real estate is also a place that there's a lot of really bad advice going around. So what would you say is the worst real estate advice you've ever heard?
I ignored it and moved it out of my mind. So I don't even know.
All right, fair enough. I think that's the best answer I've ever gotten to that question. All right, so let's take a nod to the randomness in the universe. I have about 500 random question cards here. Just tell me when to stop cutting the deck. And
okay. All right, right about there.
All right. Oh shoot, we asked this one already on the show. I should just throw these out when we're done. If you knew you wouldn't get hurt, would you rather skydive or view sharks from an underwater cage? Let's take the next one. Oh, this one's even worse. What are your favorite apps?
My favorite apps?
Favorite apps?
The one that immediately comes to mind is the Calm app. I have, over the last number of years, realized the value of sitting in silence and taking some time for meditation, and come to understand that it slowly rewires your mind to be able to have a much greater capacity to deal with and manage stress. And so my Calm app is something I hit every single day. And I keep my trusty, these guys right here. I can be in Starbucks and just sort of in 5 minutes get to a place of being super clear-minded. So I'm going to say my Calm app is my go-to right now.
Beautiful. And if I'm not mistaken, I think that was one of Jason Calacanis's early stage investments. I did read his angel investing book, interesting figure. And I think that is, as I remember, one of his favorite examples in the book.
Very cool. It's been good to me. It's daily use.
All right, there you go. Capitalism, angel investing. You can see these are real things helping real people. This is your proof here, ladies and gentlemen. All right, can you name a book that has helped to forge you as a leader and as an entrepreneur?
Another one that comes to mind is the Keith Cunningham, The Road Less Stupid is what it's called. And it talks about the three, if you were to eliminate the three worst decisions that you've made in your life, how much pain would you have solved yourself, whether it be relationally or financially? And I think that's pretty fascinating how he talks about taking the time to have thinking time. And so I do that now as a matter of practice. So I'll take time to just think with no other agenda. And I think the world could use a lot more thinking time than it has, because people waste years or decades of their life by making poor decisions simply by not taking the time to think. So I'd say The Road Less Stupid by Keith Cunningham. Or that might be the title. I know it's Keith Cunningham, and I'm pretty sure it's The Road Less Stupid.
Love it. And reminds me of two of my favorite investors. You mentioned being a value investor, but Buffett and Munger. I mean, you can see pictures of Buffett and he'll be sitting at his desk and, he's reading the newspaper and he's thinking, right? You can tell that he's there to think. And he'll say things like, if you turn your portfolio too often, right, you're just damaging your returns. He's not afraid to just spend the time to learn, to think, and to make the better decision. And Munger, I know he's been described by his children as a book with arms and legs. And gosh, I can't help it, because look, there's one more quote that's hitting me right now, that books are literally the most concentrated form of learning. I mean, you go to podcasts, and I hope you come to my podcast every week and listen. I appreciate my listeners. But if you take the time, when you're not at the wheel or gardening or whatever you're doing, when you're listening to this podcast, hope you're not doing something dangerous, but sit down with a book. I mean, literally, the amount of time people put into a book and the quality of the information, literally the information density that you can get out of a book versus a newspaper, article, webinar, etc. It's amazing. So yeah, I think people who actually take the time to read, these people got it right.
Well said.
All right. So how has a failure or misstep set you up for later success?
Early in my career, I got spread too thin with too many different interests at once. And I became, I'm going to say, watered down and mediocre at a bunch of things. And it was a costly couple of years. And so now everything that I do, I look at, is it an area that I love? Is it an area that I have a level of expertise? And is there nutritional value? So if I'm going to go outside of something that is my main push, I'll look for, does it have nutritional value in a sense? So I'm an investor, and I am, partner in a mortgage company, and then the founder of the Cyrus Opportunity Zone Fund. But all of those have nutritional value. And so I want to make sure that I'm staying kind of within reach so I can bounce back and forth and add value between all of them at the same time, rather than being spread thin. So that's something I learned the hard way over the years.
I love it. This is true advice from a Renaissance man. So you may be doing a lot of things, but there's a theme or a thread that runs through them all.
There's a theme, and I can jump from one track to another and actually add value to both, as opposed to taking away from one or from the other.
Awesome. Can you send us out with a quote to help forge our listeners as leaders and entrepreneurs?
I sure can. All right, let's see here. Yeah, okay, this might be Charlie Munger or Warren Buffett. It's one of the two, but it is show me the incentive and I will show you the behavior. And that has been one that I've come to truly appreciate in all areas of life, is you align incentives and make sure that everybody wins together. And it's amazing how when that happens, you don't have to be the one pushing so hard all the time because everyone's driving the same direction. Sometimes you're drafting, sometimes you're leading, but show me the incentive and I'll show you the behavior.
Wow, I love it. I have to say that's possibly the most positive formulation of the dismal science I've ever heard. All right. Now, amazing interview. I want to thank you so much. You've been very kind with your time. I think we've run over an hour. And thank you very much for sharing your knowledge and experience with our audience. I just want to make sure that everybody has an opportunity to reach out to you. What is the best way to reach out to Mike Hardy?
Yeah, absolutely. So I would say I can give my email. The website, first of all, is CyrusOZFund.com and CYRUSOZFUND.com, and Mike at CyrusOZFund.com will go direct to me.
All right, amazing. So if you're driving, well, keep your hands on the wheel. We're going to put that in the show notes. Thank you so much for taking the time to talk to your audience today, Mike.
George, it's been a pleasure.